Jessica, it's great to have you here. I mean, honestly, you are the right person at the Fed.
If you're interested why consumers act and how they act when they choose to pay a certain way, we do this study annually, and it even breaks down.
Let's let some folks ask some questions.
My name is Jessica Washington. Thanks for joining us this afternoon, and I am so pleased to be here. I'm humbled to be here with you, Gary, today. I kind of grew up in payments in the ACH side of the house, and I've been with the Federal Reserve Bank for about 10 years now. And when I started at the Federal Reserve, I started studying prepaid. And I dove into that industry, and I got really passionate and connected through that. The Federal Reserve Bank of Atlanta is one of 12 private reserve banks, and we represent the 6th district. And the 6th district is really cool. We have Transaction Alley in Atlanta, in Georgia. We have a good partnership with the American Transaction Processing Coalition, with also Fintech Atlanta. We have over 245 fintech companies in Atlanta, about 43,000 employees. We have, within the University of Georgia system, fintech pathways at every university in the system. And it's just really been great to get the diverse perspectives of fintech. And we're just a payments hub. 6 out of the 10 largest payment processors are in Georgia, and 2/3 of all card transactions do flow through Georgia. And the Atlanta Fed is kind of cool too, because at one point we were home to the retail payments office, which we still process about half of all ACH items in the country and about 1/3 of all checks. And some really cool history I just have to throw in before we start is Atlanta's was once known as Terminus. All the railroads led to Atlanta, and many years back there was some laws passed that allowed for some large cable to go under those railroads that provided that pathway to Transaction Alley. And you're a legend in Transaction Alley and prepaid and all these things that I've been studying over the years. My group is a research and outreach group, and we get to conduct several studies. I did want to mention the Consumer Payments Diary and Survey of Choice, because if you're interested why consumers act and how they act when they choose to pay a certain way, we do this study annually, and it even breaks down demographics. I just wanted to shout that out during the last session. But Gary, introduce yourself, and then I have some questions for you.
Well, first of all, I have imposter syndrome of the highest order. Jessica, it's great to be with you, and like you, a little bit of a disclaimer, I've been an industry advisor to the Philadelphia Federal Reserve Bank since 2005, first to the Payment Card Center, and then to the Consumer Finance Institute. And anything we say here, these are our opinions, not those of the Fed, Atlanta, or Philadelphia. But sitting in the room with folks at the Philly Fed and the Atlanta Fed for the last 20 plus years, again, I feel like an imposter. I'm not that smart. I definitely don't have the educational background they have, and it's just been extraordinary being around these incredible people. But when I was way back in my first company, which was the early days of prepaid, we built, as I shared this morning, the first issuing processor for banks. And by the time we sold the company in 2005, 7 of the 10 largest US banks were our customers. That early experience was truly unbelievable in helping me understand how regulation works, how technology works, and how they don't work so well together sometimes. The problem is, you fast forward to today, very little has changed. One of my dear friends, he passed away last summer, was a gentleman named Jim Robinson III. Jim was a legend in the payments industry, CEO of American Express for a long time. He took American Express to China. But Jim preached a very simple message to everybody, which is organizations must change for the better, or they will lose or die. Doesn't matter whether you're a regulator, a central bank, a business, a big business, a small business, you always have to be changing for the better, or you're going to lose. The topic of this discussion is really something that's near and dear to my heart, because in this particular area, it hasn't changed that much. And I'm not intending to throw dispersions toward any regulator, OCC, FDIC, Fed, anybody, or even to banks. But what's happened is that for whatever reason, whether it's self-interest or whether it's just familiarity bias, we haven't changed. And as a result, our payments system and our payments framework is no longer keeping up. And we have things breaking around the seams. And so what I've started to do about a year ago, and I don't have a dog in this hunt anymore. I provide technology to central banks, correspondent banks, anyone in the cross-border ecosystem that's never existed before. We've built a massive infrastructure. But this conversation is about really all of us, either directly or indirectly, but it's challenging the notion that a classic federal bank charter is enough. I just don't think that it is. And it's not just an opinion, but it's from having now worked and lived abroad for the better part of 20 years. And having been the CEO of an e-money institution in Europe, which is a chartered institution regulated by a central bank, but it's not a bank charter in the US. And so, and candidly, Jessica, when we were putting this discussion together, I had invited some of the US's leading CEOs of what we would call Fintechs, which do have a dog in this hunt. And they all passed because it's too sensitive. They're worried that their commercial bank will be upset at them. They're worried that the regulators will be upset at them. And I really applaud Jessica for being willing to ask me these questions and get my point of view, because this is a subject that we have to rise above sort of our self-interest and look for a better way of enabling safe, innovative products that consumers need and want. And it starts with safety and soundness, but also capitalize on an incredible amount of innovation and investment that wants to come into this space and innovate, but is challenged because of the current chartering framework. And so that's what this discussion is about. And I'm confident you're going to see a lot more folks, whether it's at regulators or investors or venture capital firms or private equity firms, really talking about the need to evolve our approach to chartering. Everything we've talked about today, every single session, every single panel, touches innovation, touches regulated entities, touches banking, and there are inconsistencies and inefficiencies that prevent the best of us, the best of our ideas from being commercialized in a way that are safe and benefit consumers. And that's really what this conversation will be about. It's challenging that paradigm or debating that paradigm.
Excellent foundation. And when Rich Oliver formed my group, it was to get in front of these conversations and to really be able to have policy discussions before they happen, and to make sure that we keep the payment system innovating and efficient. Well, I want to talk a little bit about your experience living and working in a number of different countries over the years, providing technology to banks, innovations for new products and services, and particularly CEO of an e-money institution in the EU. And I was wondering, could you give us an overview of what the differences of e-money, how it's treated in the EU compared to how we treat it here in the United States?
Absolutely. So in the US, all of you who work for banks are familiar with the bank charting process. It's a lengthy process, it's an expensive process, but you get this incredible license that gives you the ability to offer a wide range of products and services. And you build a business plan and you go to the regulator, it's a part of the application, and you eventually get approval. In the European Union, they've created different types of charters beyond a bank charter. I'm going to keep it kind of broad and high level, so don't be overly energized if I don't address every single nuance either in the US or Europe. But an e-money institution, and the two that are most common in Europe are an e-money institution and a payment institution. A payment institution license essentially gives an entity the ability to acquire transactions at a point of sale. So what's happened, to kind of draw an analogy from the US, First Data and Global Payments in the US operate with banks. The bank's the acquiring bank, those guys provide technology. In Europe, each one of those institutions has their own license. So they can sell to merchants using their payment institution license and using their technology. An e-money institution is similar, but it's on the card issuing side. And by the way, that license, to get that, to be able to do that, it's about 150,000 euros, not $5 million. So you can imagine the type of innovation. By the way, the entities are regulated. There's no lax of regulation. An e-money institution gives the entity the ability to issue electronic money. Think of that as money in a digital wallet, a virtual account, or a prepaid card. That e-money institution license, and it's very specific about what you can and can't do, but that runs about 350,000 euros to apply for that license. So 5 million, do a bunch of things, 150,000 euros, 350,000 euros, do a very finite set of things, just to provide some sense of framework and contrast between the types of charters that are available.
And here in the US, if you want to not become a full-blown bank, you will get licensed state by state under the money service business.
You can, but you can't become a member of Visa and MasterCard to issue a prepaid card. And you still need then a bank to do that. And you still then you may have your own entire regulatory team, but the bank also has a regulatory team that oversees you. So it's layers of oversight that's rather inefficient. So you can do it, but it's not efficient.
Okay. Now in the United States, would there be an example of something that would be appropriate for an e-money charter?
So yeah, and this is going back to my early days. The best example are prepaid cards. And I'll never forget my first introduction to the Philly Fed was circa 2004, 2005, when a number of the regulators, state regulators, OCC, FDIC, the Fed, were trying to figure out how to regulate prepaid cards. There was this big debate. Do they fall under Reg E? Do they fall, where do they fit? And I, again, being young and ignorant, I didn't realize how the Fed works, but I was invited to go to Philadelphia and to present to the Payment Card Center all of the different use cases of prepaid cards. And I remember calling my big bank customers, some of which were investors like Bank of America, Wells Fargo, and a few others, and said, hey, I've been invited by the Fed to brief them on the use cases of these cards that you're issuing. We were powering the payroll cards for ADP and Paychex, Simon Malls gift cards, incentive cards, rebate cards. And we had all these financial models that we knew what the income elements were of those cards to the bank. We knew what the cost elements were. We knew what the risks were associated with loading funds, the risks of spending funds. And so we had all these cool economic models that showed how a gift card had very small profitability, but had other benefits, where a payroll card had different. So my bank partners, by the way, customers all said, don't go to the Fed. If you give them an inch, they'll take a mile. Stay out of it. Let them figure out the regulations on their own. And my reaction was, that doesn't sound very logical to me. I think I need to help them understand this. And at the same time, the reason I was really motivated is one of the regulators had published a report that said, we think all salary cards, payroll cards should be set these fees. So it was like, uh-oh, a regulator's trying to mandate a fee structure in a free market economy. Kind of, again, my natural inclination is that doesn't sound very good. So I took the invitation, briefed the Fed on this, and they published a workshop paper. It's still out on the Fed's site. And that was introducing me into this idea of prepaid cards. But as a part of those discussions, the Fed were asking me, talk to me about regulation and oversight and safety and soundness. Fast forward to when I invested in and started this e-money institution in Europe, and we built a tech platform, we got our license, and we began issuing our cards. And I would sit down with the regulator under the e-money institution license and have a one-on-one relationship with the regulator. And I saw this incredible difference of transparency and of efficiency. And I mean transparency for the regulator. They didn't have to sit down with a bank who was supporting program managers who were doing payroll cards and gift cards and incentive cards and teen cards and GPR cards, where the bank compliance executives and risk executives, it would be impossible for them to have the deep subject matter expertise of each one of those cards the way the program managers did. And they had these massive risk and compliance teams at each one of these institutions, versus that quote-unquote program manager having had a license, let's imagine that was possible, sitting down with the FDIC, the OCC, or the Fed and saying, here's my program. So the best use, the use case that I want to use, and there are dozens, but the best use case to make this real and to make this tangible for this conversation is prepaid cards.
Mm-hmm. And I thought that, I've read those papers when I first started at the bank, and Bob Hunt, he says hi, by the way, but I always thought prepaid card was a misnomer and a real disservice to the full features and functionality of that innovation and the different case studies. But this is really challenging now in the US. Like, how do we embrace something, like, have we ever seen anything like this kind of change before?
So I was thinking about this last night, and most of you are far too young to realize this. And it's a side comment, self-interest and big problems have a way of motivating a lot of people to find a solution. In the 90s and early 2000s, there was a move away from food stamps to electronic benefit transfer cards, EBT cards. And in the early days, the Fed and the states went to the banks under the bank charter licenses and said, listen, we want to move to a technology platform to deliver these social benefits. Well, in the very beginning, a bunch of banks threw their hat in the ring. But over a course of a few years, most of the banks exited. And their reason was really twofold. Number one, they couldn't make any money at it. And number two, they were so worried that these tiny little products, in the scheme of all of the products they offered, if they ever failed and a poor mother or father couldn't get money to feed their children, and by the way, the cards had to work in a particular way. You had to do SKU level authorizations, very complicated stuff. And if Pedialyte got approved instead of PediaCare, the banks were worried if any of these things get sideways and we're on the front page of the Wall Street Journal of something bad happening and we lose all of our market valuation or we take a big hit on our market, it's just not worth it. So the banks exited. We only had two or three banks actually doing it. So the feds and the states were like, uh-oh, what do we do? Well, I had sold my company to a company called eFunds. What I learned was that kind of quietly, eFunds had been given permission to issue EBT cards. So here was a non-bank granted a quasi-waiver by the feds and the states to issue EBT cards. We don't talk about that much. But the point is, necessity is the mother of invention, creativity, and exception. And this is sort of a one-off example, but there are a few more. But this is an example where if we need to do something, we can figure out a way to do it. Now, I would rather we do it the right way by changing our chartering paradigm, but that is an example of where a form of sort of fintech that's not early, you don't want to call it a fintech, eFunds was issuing EBT cards for, it was either 12 or 18 states.
Wow. And they sold to FIS, correct?
We sold FIS in 2006.
Yeah.
So it's still, I haven't followed it in the last couple of maybe 10 years or so, but I'm assuming it's still operating.
It is. There's really only two main EBT providers today, and FIS being one of the premier. So let's talk about these new charters being in the United States, and if they're limited charters for particular products or services, payments, e-money. There's a lot of criticism that consumer protection would fall through the cracks and maybe expose taxpayers or FDIC insurance. How would you respond to that?
First of all, having worked now with the Fed for a couple of decades, consumer protection is sort of at the top of how I think and operate. The second is, as a taxpayer, I don't want my money going to funding some crazy entrepreneur who has a bad business idea. And as a consumer, I don't want to buy a product from one of those crazy guys and wake up and see my money is gone. So the way that's dealt with in Europe, and again, I believe that we in the US should take inspiration from what has been happening for 20 years, 15 years around the world, and learn from what others have done. So what others have done that's been right is that if you get an e-money institution license and you can issue a prepaid card or electronic money, you have to segment those funds from your operating account. So it's called either being ring-fenced or safeguarded. And you have to prove to the regulator every time you have a review that your customer funds are segmented. Now, there is a problem we have, and it's inconsistent in the European Union, and it's something I feel strongly about. Those funds should be segmented at a central bank. There are only one or two central banks in Europe that support that. But in the rest of the European Union, just like in the US, if you have an MSB license, a commercial bank holds your funds. But the good news is the funds are segmented from the crazy fintech entrepreneurial's operating account, so the funds can't be lost. So there's no FDIC insurance risk. There's no taxpayer risk. The second thing is that under the e-money institution license, they can't issue credit, so they can't make loans. So you're isolating even further what that institution can or can't do. They can't pay interest on the balances. So the charters can be very narrowly defined to protect consumer funds, to prevent either FDIC insurance from being triggered or taxpayers being asked to foot the bill. And they can also be created in a way that you're making it efficient to oversee these these e-money institutions, because from the examiner's perspective, everything is clear what they can and can't do, and so it's a much more efficient licensing paradigm.
Very interesting. So a few questions and thoughts came to mind. So as far as the PSD3, the proposed rule, I think they're now going to be like one license, payment institution and e-money institution. So that's interesting to follow. And thinking about like banking as a service and like efficiency of regulating and how that trickle down is passed to the bank to really be, on top of their game, due diligence wise, to regulate. And that can be very cumbersome to a financial institution who has other business to attend to. And I'm really curious about this because in Georgia, in 2012, they approved a merchant acquirer special banking license, and Fiserv has just been approved for it. So I was actually on a call with the Department of Banking and Finance, and we were chatting about it. And they're getting ready. And of course, Fiserv is a significant service provider, so they're regulated already by financial regulators on a regular basis. But now they will have this special banking charter, and there's probably going to be people to follow. And how have you seen this not really, like how are regulators able to manage this type of maybe potential volume of new clients, customers?
Well, a couple of things. It's those of you who work in banks who feel the constraints of not having enough technology or budget resources for innovation, central banks have the same problem. It's difficult to be a central banker. It's difficult to be a regulator. So part of what we think is essential is that central banks and regulators up their game. That there are now tools available that can help them digitally board applicants, digitally manage the life cycle of those relationships, monitor and observe transactions in a way that they've never done before. So it's going to take a technology upgrade at the central bank or regulator as well in order to be able to accommodate all these new licenses or proposed licenses but not all of these. I'm suggesting taking baby steps,
right.
But having a new license or two.
So in the EU, who's the supervisor of the e-money institution, the direct supervisor?
It's the central, they varies by country, whether it's the FCA, they have all these different labels, but it's the common banking regulator. Okay. There's no separate regulator.
Okay, and that reminds me of, so last year the Federal Reserve started a novel activities program in their supervisory efforts, and so this actually similarly, it runs alongside regular banking portfolios. And as banks take on digital asset, cryptocurrency customers, or they have very complex fintech relationships, those novel program activities will follow and assist in the supervisory efforts. So it's kind of just in vein with. Working with central banks around the world and as your role as an advisor at the Philly Fed, do you believe, what kind of products do you think should be chartered in the United States?
Well, I would start with like an e-money institution license that allows for the biggest sort of novel derivative product we have, which are prepaid accounts or digital wallets, to be regulated separately. And part of my view on that is that at the end of the day, not only are they safer, but customers are going to benefit. And the reason why is that, as I shared earlier, all of these operators, whether it's PayPal or other digital wallet providers or the big prepaid guys, they've already have in place these massive regulatory and risk teams. So they have what it takes. Now, we know, we've heard earlier from Don, and we all know this, that ultimately, when a prepaid card program or program manager is working with a bank, if there's a failure of that program, it's the bank that gets whacked. So the bank has overlaid all of their risk and compliance folks as well. So by having a regulator overseeing a bank who's overseeing a program manager or a wallet operator, we've got two levels of duplicitous activities. If there was one working directly with the regulator, it's in a more efficient environment. The regulator has greater see-through. It's a lower cost, which ultimately means that customers are going to get even a better priced product. So this is not intended at all to create either higher risk situations or higher risk products, but it's intended to bring value and safety and convenience to more consumers.
And I was reading on the plane over the UK's new vision for payments, whatever the title is. They already have a payment system regulator there in place, but they're now putting in place an additional, payments vision group that's public-private collaboration to oversee this new phase, and we lack that here. And payments are very hard to understand. And I know, being a payments expert and understanding all the ACH rules and so forth, payments need to be treated a little bit differently, and by those that understand that an ACH funds a prepaid card and those kind of things and understands all those nuances. But, financial institutions are, where some are being very successful with banking as a service. Do you see this e-money charter as being a direct threat? Will they be interested in supporting? So
I think today, the initial, reaction from most banks, and I'm also an investor in some banks, and I've got good friends that are bank CEOs. When you talk about this, just in a casual conversation about, we need a new charter for e-money institutions, the knee-jerk reaction is, that's all I need is another competitor. But that's the knee-jerk reaction from a bank. But when they begin to think about it more logically, some of these products that the fintechs would like to offer, or that we call them fintechs would like to offer, they're not even necessarily products that banks are equipped to support. And many times they're supporting them just because there's a big, powerful company behind it, that they have a larger commercial relationship with the bank, that they've agreed to sponsor their bins or hold their deposits. And so it's when banks really begin to analyze which of these products could be threats to their business, not many of them are. At the same time, offering an e-money institution license, it creates an opportunity for banks themselves to invest in these companies, to dip their toe in the water, and to see if it's a service or product that their customers would like. And that's been an evolution over the last 20 years in Europe now, is that more banks are actually investors in e-money institutions and supporting them along the way. So I get it. The initial knee-jerk reaction is, it's a competitive threat, we shouldn't be doing it. And I guarantee, just like when the OCC published the comments, wanted to get comments on a fintech charter a few years ago, you read a whole lot of bad, scary things from banks that were going to happen. It never happened anywhere else in the world. Why is in the US we're going to suddenly have this implosion of our financial system by offering a new charter? It just hasn't happened.
Well, since you brought that up, last question, it could be a can of worms for the last question, but the role of the states, because in the chartering paradigm, they could nationally charter with the OCC or a state charter, and then become either a member of the Fed or be oversaw by FDIC. So how do you see the states playing a role in this future?
It's messy, and this is purely a theory that I have, or a recommendation I would have. If there are any state regulators in the room, say in Poland, to issue electronic money, you can send a passport notice to the other 20-some states of the European Union, and they have 30 days to dispute that applicant, and if they don't dispute that applicant, then they can operate in that country. And so if I were the states, I would say, listen, if we get really good at this, we can attract all kind of new investment, new innovation, we can create new jobs, and we can do it safely. Let's agree on a model framework for regulation of these new e-money institutions. And states are really good at coordinating their activities and many of the laws they passed in this area. And so that, in other words, we have to also overcome the inefficiency at the state level if a states decide to do this, where you don't have to get a money transmitter MSB license in all 50 states. It's too expensive, takes too long, it's too cumbersome. But if the states were to adopt this passporting paradigm, and having trust and confidence that the state that issued the license is going to properly regulate that entity and follow an agreed upon set of rules, the states could actually fill a void if the Fed, if the OC, if someone else doesn't. So I think it creates what we like in the US is healthy competition. And so the states and the Feds sometimes enjoy that competition themselves. And I have a theory, a belief that it's not a theory, competition that in everything makes us better. So if the states were to offer a competing alternative and the Feds offered a competing alternative, I think that we could all see better products from that.
Well, I think one thing I've learned in my research over the past few years, we've been looking at payments inclusion and really trying to understand like what is banking. It's not necessarily having a traditional bank account anymore. Sure. So really trying to understand like where we need to go with policy in order to keep up. But I do agree with your comments on competition. I'm really interested to see what happens with the Georgia merchant acquiring charter. Like I said, it's been around since 2012, and there has been another company that was approved, but they were smaller and Israeli-based, and they weren't able to get a Visa direct connect. So we'll see what happens with Fiserv, but I think we know that there's going to be more competition as far as others applying for that particular charter, but I think other states are going to be interested. I think the only there's several requirements, but one of them is you have to have at least 50 employees in the state of Georgia. But it's going to be an interesting couple of years.
Jessica, it's great to have you here. I mean, honestly, you are the right person at the Fed to be facilitating this conversation. It's really exciting. And since we're at the end of the day before dinner, this is a provocative subject, I get that. Let's let some folks ask some questions, because there are some things, oh, good, we got hands going up everywhere.
So just to kind of throw it out there a little bit, isn't there similarities in terms of licensing as a money transmitter, the MTLs, versions of finance companies? In the state of Utah, there is a pretty active environment for all of this, and it's not at all slightly off the idea recommendation of the e-money license.
I totally agree, and let me kind of add a follow-on perspective here. The issues in the US with that licensing construct are that you can issue maybe a digital wallet or engage in certain forms of electronic money, but there are a couple of big deficiencies. The first is that license doesn't let you become a member of Visa and MasterCard today, whereas in Europe, the e-money institution license does. The second thing is, and this is really, really important, and it hasn't been completely figured out in Europe yet, but even when you get that license, you still have to go to a commercial bank to hold your money and to access the payment system. This is a problem. Now, there was a central bank in Europe, the Lithuanian central bank. The lead board member of that bank is a guy named Maras Jurgilas, and we're friends. And before the pandemic, think about this for a second. There are 26, 28 countries in the EU. I forget exactly how many. But 1 out of every 4 e-money institution applicant went to the Central Bank of Lithuania. Now, why was that? Did he have a weaker regulatory framework? Did he have a weaker oversight? No. He delivered 2 services that no other central bank offered. Deposit taking, so the e-money institution didn't have to go to a commercial bank. Today, the MSBs, the MTLs, all have to go to a commercial bank. And 2, access to the SEPA payment rails. So he gave those e-money institutions the ability to make a real-time payment through what we'd call ACH or FedNow without going through a commercial bank. So if we're going to do this properly, and I'm an advocate for doing it properly, the e-money institution charter or the state charters, the state need to evolve to include the ability to access the payment system through a master account or similar account at the Fed. So you can access Fed Now and they can hold your money and it can be segmented, because the commercial banks, let's all face it, if you're at a commercial bank today, most of you have policies against MSBs where it's okay, we can all talk about it, we're friends here. You can't get an account at a bank. So the feds, and this is where another state could really get exciting. If I were running a state regulatory authority, I would get a master account at the Fed. And I would support the MSBs or the e-money institutions in my state through my master account. There's a lot of creativity that can be put to play here, but these inefficiencies that exist, these disconnects, prevent these states from issuing MSBs or MTL license that can really be what they need to be.
A couple of months ago, to the subject of whether the states are productive and efficient or not, Chicago Fed Payment Symposium, Undersecretary of the Treasury Nellie Lang put a shot across the bow and said, we think the Fed ought to regulate digital payments because the states have got everything mucked up. Comments?
That's just, it's just inefficient. I can't say any more than that, but I think it's an example of a gap in the federal regulatory oversight. I'm going to let Jessica answer that one.
Steve, good question. I was there for that, and actually that speech is available online by Nellie, and I agree. And we actually, our rich fintech community, the payment processors in Atlanta, and this is my opinion, but they tell us, they're like, we want you to be the payments regulator, but from where I said I have very little control over that.
Guys, let's all make this change. You're going to be asked over the next, I'm sure some of you, over the next few months and quarters to be a part of advocating for a change in how we issue chargers. We need to, it's at the end of the day, it's in all of our best interest. It'll be better for consumers. It will attract innovation and investment. There's a ton of venture capital that wants to come into this. But who wants to invest in a business where you don't know how you're going to be regulated, who's going to regulate you, and whether you can get a bank account to operate your business? There are way too many things, and the U.S. should be leading this globally, and we're so far behind, being candid. We have to make a change in our regulatory construct.
And the proof is there. Over the past 2 decades, third-party risk, third-party risk, fourth-party risk is all, the guidance that we've had from the regulators that we're so, obsessed with and have to stay in front of. And it's still not something that we're solving. So maybe first party will be the way to go.
We're going to fix it.
All right.
Thanks, everybody.
Thank you.
Thank you, Jessica. Thank you so much. Thank you very much.